All right, well, welcome everybody to today's broadcast. Today is March 3rd, and it's Super Tuesday. And once again, the markets are going up and down and up and down and going crazy here as they have done for about the last week and a couple of days. So what we thought we would do is we would have a little bit of a roundtable discussion with all the advisors here at WWM Financial. So the question that we have currently is, first of all, what do you guys think is going to happen with the market? And then we'll talk a little bit about what's happened today. So I'm going to open it up to whoever wants to go.
Well, I think as far as the markets, today's volatility was probably caused more by what the Fed did by lowering interest rates and kind of surprising the participants for the most part. We're not sure what effect that's going to have longer term, but in the end, this coronavirus, like most viruses in the past, will run its course over time. Trying to sell or take drastic action in markets like this is usually not the best action. And if you got a properly built portfolio, just stay the course and make adjustments if over time, when the markets get back to normal, maybe if you had too much risk, that's when you should be doing more of the bigger adjustments.
And I would agree with that because this isn't the time you want to be making changes. Throughout the year or even now, you have to look at, do I need money or what's the cash flow? Unless you really need money, then you shouldn't be really taking money off the table in big increments. I know Steve does some with some of the trading that you do, but that's more of a tactical approach that he does. But definitely, I would agree. Don't be making major changes right now. These markets are moving pretty quick, and we've had a lot of calls. We've been talking to a lot of clients, and that's what we're here for. We're really here to talk through, make sure people feel comfortable with how they're invested and what we're doing.
I'm going to stay on the coronavirus for a second. It's exceedingly rare in the U.S. As of yesterday, I think maybe there were 6 confirmed deaths. We keep hearing outbreak. We keep hearing pandemic. But the 6 deaths are much less than the common flu. Now, the virus is highly contagious. And according to a number of the specialists that I listened to from the CDC yesterday, the transmission method is still not well understood. However, they're doing their best to bring the best minds of healthcare together to look for treatment, to look for vaccines, and they are telling people to take as much caution as they can.
Yeah, I was just going to say, I think one of the things to be aware of is this thing will probably be something that'll be with us for a while. And what I mean by that is not necessarily in this uncertain, severe of a situation where we just don't know what's going to happen next week or next month, but it's probably still going to be around. The good news is most people are not getting nearly as sick as the ones we hear about over and over again that have passed away in China or the few that Vince mentioned in the United States. But it's something that's going to cause some volatility or some up and down in the market for a while, probably. And so, make sure you're allocated the proper way and write it out. I mean, if you need to talk to us, but it's going to be around. But
Scott, I think that this is going to get worse before it gets better. We talked about this about a week ago, and in that time, we've seen the markets go up and down. But I think the flu itself or the coronavirus has to run its course. And until it runs its course, I think that the market is going to be a little bit jumpy. Just up 900, down 900, up 1,200. I mean, that's a lot of volatility. So we've told you before, if you need cash, get out of the market with that amount of cash. But for most people, the money that you guys have here is not necessarily money that you're living on. So panic is not a strategy. All right. Just so we've talked about this before. Panic is not a strategy. Hope is not a strategy. So that's the reason that you've got advisors to figure out what is your strategy. So that's kind of where I am right now.
Because you also think about what's the impact with businesses, because we're obviously seeing the markets, but what's going to happen over the next quarter or when you actually see the results from some of this impact across not only the U.S. but globally. So I do think there could be more of an impact that we don't know about. But I do agree, once again, this isn't the time to be jumping in and out.
And Catherine is correct, because what we're seeing is that a number of large cities are being put under quarantine. And so what happens is factories are being closed.
Where is that? You mean in China?
Well, in China, in South Korea, in Italy. And what's happening is you're seeing factories closed. You're seeing airline flights canceled. You're seeing cruise lines canceled. You're seeing cross borders being tightened, a lot of travel restrictions. And what that will lead to is inevitably world economies will slow. In fact, we're hearing from big companies such as Visa, MasterCard, and other large financial companies that they're saying their cross-border transactions are slowing dramatically. And that means that travel is slowing dramatically. And what's happening also is they're now saying that they're not having a good handle on their revenue or earnings per share for the coming quarter or possibly even the coming year. So you will see some volatility in the market. And Steve is absolutely right. You might see this market go down even further, but that could be good from the overvaluations that we saw not more than a couple, 3 weeks ago.
Yeah, no, I think that's right. When you're looking at what is your time frame, okay, if your time frame of your investments is tomorrow or the next month, then this is going to be pretty tough. But if you're looking at where we will be in 2 years or 3 years, there are some buys out there already, which I think are pretty good, but they may get better. So you want to, if you have some extra cash or you have some dry powder, just put it in very slowly. And I think it's like dollar cost averaging. You'll do fine in the long run, but maybe not in the next couple of months. What do you think, Greg?
No, I would agree with that 100%. I think the GDP numbers, like Catherine said, are really going to start seeing the real effects of this economically in the second and maybe third quarter of this year. But you'll see a lot of the pent up demand once the supply chains get back on track, especially over in China, because that seems to be where everything flows through. Things are produced there. Other companies ship stuff there to be assembled. But with them being quarantine basically for the last month or so, that's all stopped. But that's going to take time to roll through.
What about the 50 basis point cut? Does anybody here think that the 50 basis point cut is going to stop the market from going down or help the economy for that matter?
I don't think
Not really.
that is going to have any effect on it. And I think the market is showing that today by going down over 1,000 points from the high today, after it was announced.
And I think in some sense, the Fed was sort of backed into a corner where they felt like they had to cut, because if they didn't, there might be broader panic in the markets, panic selling. And if they did, will it necessarily cure the economy? No. The virus isn't cured by 50 basis points lower, which just means 0.5%, because interest rates were already low. On the other hand, if they didn't cut, then people might, as I say, sell even more. And so it was a good stabilizing move. But as you saw, we still had 1,300 points up yesterday, and who knows today.
Yeah, I also think that what the Fed has done by cutting 50 basis points, it puts the emphasis back on risk assets. And when the 10-year bond is trading somewhere around 1% or slightly below, that's not a wonderful return. So when you compare it to what an S&P dividend yield might be, somewhere at 2.4 or 2.5%, or possibly even a bit higher, the Fed is almost forcing your hand to move back into the equity markets. And maybe that's their way of saying we will stabilize the markets over the long term.
So by risk assets, you're talking about stocks.
I am talking about stocks, yes.
So if you were to buy things today, well, first of all, would you buy things today?
I have a list of names that I have put together. I don't think that it's time to buy. I think you're going to see another few days to maybe a week before we start getting to some support levels that we saw probably last December when the market sold off quite hard. I thought that 30.25 was going to be a good number on the S&P, but
and where's the S&P now?
Oh, it's well below that. It's around the 29.75 mark right now. So that broke those support levels. I do think that if you're looking at really good quality companies, things like Microsoft, Apple, MasterCard, Visa, even though JP Morgan or, something similar to that, I think you can begin to buy those knowing that over the long term, as you said, 2 to 3 years, these stocks are going to perform very, very well.
Right, but just so you know, we're not necessarily recommending everybody go out and buy those stocks. So if you're thinking about doing that, talk to us first.
So what do you think about this epidemic being something different? I mean, in the past, we've had Ebola, we've had Zika, measles, we've had so many different things that happened in the past and the markets recovered. But this time it seems like everything moves so quickly. And I don't know. I mean, I feel, is this different from something that's happened in the past?
I think so. A couple of the differences is the timing of some of those, because the last couple, I believe, have been after the market has already dropped significantly, where this one hit us at a market high. And to get back to the 50 basis point cut, when's the last time the market pulled back 10 or 12%, going back a number of years, 10 or 12%, and the Federal Reserve has to drop rates so much. I mean, the markets used to have a 10% correction every year and a half or so. We haven't had one, in a couple of years, or we've had very few in the last 10 years.
I mean, actually, about a year and a quarter ago, when at the end of 2018, the market was down about 20%, and we didn't have any kind of panic. But I'm not sure that people are panicking about the market per se. I think there's people who are panicking because they're so afraid of this virus. And I don't want to be callous about this, but I think if you put the word flu in place of the word coronavirus, I'm not sure you'd be having the same reaction, yet they're very similar. And I understand that, we don't have a vaccine yet, and I know it's contagious, and I do know that there will be people who die, but that's the same thing that happens with other viruses.
So that kind of ties back to media and news and everything else is out there, is that's what everybody's seeing, and everybody gets scared and then starts to panic. And that's obviously going back now to the investing too.
Kind of almost a self-fulfilling prophecy with all the news out there these days.
The other thing I'd like to throw out there is there's sort of an impact when these kind of things happen on the economy, and then there's the markets. And they're related, but they're two different things. So when the economy, for example, gets hurt because, as you've probably read by now or heard by now, there's supply chains in China for manufacturing things like cell phones and many other things. There's also consumers in China that are in their homes right now, not able to consume in a normal way. And so the economy gets reduced. The markets, on the other hand, as many of you may remember from 2008, 2009, not that this is an event like that, that's not my point, but you might remember that the economy in the United States was still deteriorating in late 08, early 09, but yet the stock market bottomed out and started going up in 2009 in March. And the reason was the stock market's looking ahead 6 to 8 months, maybe 9, 10, 11 months ahead into the future. And so the point is, when this virus breaks out, it might, as Steve said earlier, get worse before it gets better. But at some point, value investors or people that are looking for bargains are going to come in and say, well, enough's enough. I'm ready to move forward because I think in 6 months, things are going to be really actually a lot better. We're not to that point yet. We don't think, or I don't think, but at some point, you might see the economy still struggling a little bit from the virus in areas where, as we talked about, Northern Italy, China, and so on. But you might actually see the market start to change course. And it seems a little confusing, but that's typically what happens.
Well, don't you guys believe in gals? Believe that once the virus kind of peaks and then starts petering out, that markets will stabilize?
Yes, that would be a good indicator, and I think that's what you're saying is that once the data shows that we've peaked in the number of new cases and deaths, the economy is still going to slow down. The numbers are still going to come out for a quarter or two lower, but the markets will be looking ahead, and that'll be the time to be buying.
So they're discounting the bad news now, and probably it's purely a guess, but if the virus takes 2 or 3 months to peak, probably a couple months from now, you're going to see people coming back in. I also think a lot of this is program trading. A lot of this volatility, it's so fast that I believe it's algorithms. And algorithms, what the machines are basically saying is, okay, the market is doing X, so we're going to do Y. Maybe the interest rates go down a hair and we have to sell or something like that. And I think that's what's happening right now.
Sure. The algorithms are based on, words in the media. They're based on technical levels in different indices out there, like the S&P or the Russell or, some of the precious metals. And so, they happen so fast when those technical levels get hit or someone in the media says something, like the Federal Reserve or the president, the tweets, they react to that. And it's a lot of money moving very fast.
All right. So bottom line, we'll go around the room here. Vince, Stefano, what do you think people should be doing right now?
I think they should be hanging tight. I would not be a seller at this point. If you have your portfolio, if you're in the market, do not sell. I would not start utilizing your excess cash at this point. I would wait because I think you'll have a better opportunity. In which case, I then would start buying, and you will have a big V bottom rally.
Okay. Greg, Carroll, what would you do?
I echo most of that. I think that, until we get a little better handle on the virus itself, we start seeing some of the numbers slowing down. Apparently, the U.S. is very behind in the fact that we can't test enough people, and I think that's why those numbers are going to spike. They're already there. We just don't know it yet. So once those numbers come out, I think that's when, like Vince says, that's when you start putting some of your cash to work. But absolutely, there's no reason to sell in here. It's kind of a panic, pullback.
Scott McClatchey, what would you do?
Don't panic. Number one, we've already established that. And secondly, for most of you, most investors out there, pretty much nothing. And I hate that sounds like a cop-out. It's really not. It's just that's historically been the best course of action during these high volatility moves. And so if you just kind of hang in there, most of you will be absolutely fine. That said, if somebody's really, really nervous and you're waking up in the middle of the night and you can't sleep, you might take a little risk off the table. That does not mean you have to sell everything. That just means if you're, 80% stocks and 20% bonds, maybe you go a little less stocks. But other than that, I wouldn't make any moves at all.
Okay. Catherine Magaña?
I echo everybody here. I definitely would stay the course and call us. I mean, that's what we're here for. Is we're really here to talk to you, walk you through how you're currently allocated. And if you do have some cash, I may add a little bit with some of the dips and take advantage of some of these opportunities.
Okay, and I'm Steve Wolff, and of course I echo pretty much everything everyone's been saying. I think that there's some opportunity here too. If you've got some weak positions, some weak stocks, I still would sell those even now, and then wait for some of the great stocks to get cheaper and cheaper and buy those. You can upgrade your portfolio. That's a good thing right now. I think that when markets go down, it's a healthy thing. You get rid of what I'll call the weak hands, and then the strong hands are left. I mean, and that's, what is that? The survival of the fittest. And that's what happens. So again, there's no panic here. I don't think there should be. And we'll do whatever we can to help you through. So please, 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 if you are at all nervous, and I know all of us are a little bit nervous, but if you're, like Scott said, if you're not sleeping or you're really having some issues, call us and let's walk you through it. If it means we have to take a little bit off the table to make you sleep at night, we're more than happy to do that. In the meantime, just hang in there. And we think one more thing is that there's never, ever, ever been a time in the history of the markets that after the market has gone down, it hasn't gone up and been higher than it was before. Now, can I guarantee that this is going to happen? No, but I tell you what, I'd like to take those odds with me to Vegas. I'll be a rich guy. So hang in there. Thanks for staying with us. We appreciate all your business. Take care.